If you ever were in a live call out and you had no clue what people were saying because you never learned the verbiage, well, it's not your fault because you didn't know the language. So, we're going to actually teach you guys that today. My name is Chrissy,
And I'm George.
and welcome to Married to the Markets. So, like my husband say, we going to take them back to where?
The green stages.
The basics.
Beginner stages, basic stages, just understanding what terminologies mean. When you come into trading, you want to know the fundamentals, right?
Yeah, the language matters.
Language matters. So a lot of times when people come in, they just want to know how to put a trade in.
Yeah. It's more than that, guys, because sometimes you'll be in a live call. Like we have people that's in our live call out. If you green and you don't know what scaling out means, you don't know what calls, puts, like we got to go back.
Yeah. So we're going to start off with some terms, and this is just for beginner use case, guys. So if you're a seasoned investor, yeah, some things might come back to you, but we're talking about beginner investors that are just coming in and just want to learn more. And I feel like a lot of times we skip over the basics and the fundamentals, and you need to learn these terms.
Yeah, so we're just gonna break it down into sections, right? So we're gonna start off with the most like essential that you need to know. Then we'll
Mhm.
go into like charting and price action and understanding those, and we're gonna go through it all. So the most essential basic terms, right? Bear market, bull market. So obviously, if we're in a bull market, that means that the price is running up. We are going up. If we're in a bear market, that means price is going down. We are going
Yeah.
down.
So when you hear bullish market, bearish market, it's the same concept, right? You're talking about bullish market mean that the market is continuing to go higher and higher, right? And then bearish market, people start to panic, and that's where you see markets are being sold off. So markets are going lower and lower. One of the things that we have to bear in mind is that, a lot of times people will just think of, all right, bullish and bearish, but I still don't understand. So with a bull have two horns, right? And a bull, for them to come, when they come towards you, when they run towards you, they're gonna use their horns to do what? Buck you up, right? So you think of a bull as being going up versus a bearish market. A bear, they have claws.
Slap
They're
you down.
always slap you down, right? Slap you down.
Exactly.
So that's a concept that we use just for beginners to understand.
And volatility, because you got to know, right? How much price is actually moving. Because we'd be like, oh my gosh, this is a volatile market. People need to understand just those basic terms. So the next one we're going to get into is the price and chart action terms.
So we're gonna start off with candlesticks because
Yes.
everybody needs to understand candlesticks. Candlesticks is how a price move within a certain time frame.
Mm-hmm.
So you're gonna have different candlesticks. You could have 1 second candlestick. Do not trade on a 1 second candlestick. Not even a 1 minute candlestick. Okay. You want to stay on higher time frames, especially if you're a beginner. So every candlestick represent a certain time frame. So you have 1 minute, 5 minute, 10 minute, 15 minute, 20 minute, and it goes up to daily, weekly, monthly.
Then we have support and resistance. So support is where the buyers are stepping in. That's the level. And then we have resistance, and that's more of the sellers, right? Where selling off is happening at that time frame.
And then you have trend. So you want to know what trend you're in. A trend is always where the market is going in a particular trend. So it's either going up or down. When you're going in an uptrend, that means you're having higher highs and higher lows. That's an uptrend. A downtrend is basically going to be the opposite. So you have lower highs being created and lower lows being created. So those are going to be your trend. You want to pay attention to those. If we're sideways, which is another trend, you don't want to really stay within the side range. Yes, you can make money within those time within that range, but just know that at some point there's going to be a breakout.
So when we say breakout, right? Because we're actually looking at a particular stock right now for a breakout. And so when we say breakout, that's basically moving through a key level,
Yeah.
right? So right now, I think Nike, for existence, is moving, it's about to break out.
Yeah.
So we are looking at that just as well. That's a little gem for y'all.
Yo, yeah, get him
I giving y'all a little sauce,
yo,
a little
yo,
sauce
oh yeah,
here.
oh yeah,
And you
okay,
come to the podcast
yo,
because you want some sauce.
yo. You know what? Because you're here, you just got
You
a
got
little
that.
tip.
You
You just
got
got a
that
little tip,
breakout.
right? So Nike just about to
It's
break
about to
out
break
to
out of a key
a
level,
key
guys.
level. So with that, do your own due diligence, by the way.
Okay, so now we're gonna get into order type for every beginner must know.
Yeah.
Okay, we're going into sections for you guys. So you got the market order. This is where you're gonna get in instantly, guys. So I always tell people, because some people are like, okay, do I get the bid? Do I do the ask? Like sometimes if
Mhm.
the spread is good, guys, you could just click market and just make sure you get in immediate,
Yeah.
right? So there's no hesitation. They're gonna get you in at whatever price is there because you don't want to miss it.
Yeah. And then you have the limit order. Limit order is you putting in a particular price. And we're going to go over those as well. But limit order is saying you want to buy it at this particular price. So when you put in a limit order, that's what it is versus a market order. Limit orders, you don't have to get filled, right? Especially if the price is pushing, you don't have to get filled in a limit order versus if you have a market order and you need to get into that order, it's going to instantly get you in that trade.
Yeah, and let's not forget stop losses because it's so important to have a stop loss, right? This is automatically going to take you out of your trade so you don't occur more losses. You're stopping the bleeding. Obviously, you weren't right in your trade. And so that stop loss is going to cut that. It's going to cap you off at that particular level. So please make sure whether it's a mental stop loss or you actually put in a physical stop loss, but it's helpful to have a stop loss.
And then you have take profit, which is
Yeah,
the opposite. You want to make sure you're making money. So with
exactly.
that, you're gonna have your take profit, and that's the area that you're looking to take profit, regardless of if you have a key level, which is going to be if you're in a buy and you're looking at a key level as far as resistance that you want to sell at, or you're in puts and you want to sell at a certain level that support is at, then those are going to be your take profit areas. Just know that when you get in a trade, you want to have all of those in mind. You want to know what your entry is, you want to know what your stop loss is, but you also want to know where your take profit is.
And now let's go to risk management and money management. That's very important. These are terms that you need to know.
Yeah.
Position size. This is how much that you're willing to put inside of the trade, right? This is how much of your account you're putting in. This is your position sizing at this point.
Yeah. And then your risk to reward ratio.
Yeah.
A lot of times people will get in, and what you have to realize with options, guys, is that option price moves very quick, especially if you're trading 0 DTE options, right? So one of the things that you want to know is risk to reward ratio. So you're talking about how much you're risking. Are you risking $100 to make $200? That would be a 2 to 1 risk reward. If you're risking $100 to make $100, that's a 1 to 1 risk reward, right? So your risk to reward in us have to make sense.
Yeah, when we talk about drawdowns, guys, this is basically saying how much of your account has actually decreased from the highest point. Like you in the red at this point,
Yeah.
right? Most of the time.
Yeah.
When you're
And
like, oh man, I'm down 20%, that drawdown, that's what that is saying to you.
yeah, and drawdowns, sometimes you'll be in drawdowns, right? Especially if you're doing swing trade or something like that. But
Yeah,
also, if something pull back, you may end up in a drawdown, right? But also,
it's
you're going to
normal.
talk about margin.
Yeah.
And a lot of times when people are coming in, especially most beginners, they come in and they create margin accounts. And margin accounts is basically you borrowing against the money that you have, but also you're taking on more than what you actually have in your account. So, say for instance, if you have 5,000 in your account, they'll give you a margin sometimes to buy stocks, right? They might give you twice as much so you could buy $10,000 worth of stocks. With options, all depends, right? But what you want to make sure is that coming into options, you want to make sure that you're choosing cash account most likely. With margin accounts will allow you to trade, but it's going to restrict you from the amount of trades that you could make. Versus with options trading and you have a cash account, you could trade as much times as you want within the range of the amount you have in your account. So if you have 5,000, you could use up to 5,000 for that day.
So let's get into I hope you guys are taking notes, right?
Yeah.
Because this is very important. This is for beginners. So you take notes so you can understand these terminologies. So we're going to go into option specific terms now. So you have a call option and you have a put option. So the call is the right for you to buy at a set price and the put is the right for you to sell at a set price. So when we say, oh, calls, why? Because we think that the market is going to go up. Puts is that we think that the market is going to go down, just like we said. But these are just some of the option terms.
Now, if you're thinking the market is going to go up, and then let's say, for instance, we're using Apple as an example, Apple is at $300, but you're thinking that Apple is going to go up, right? So you want to buy a strike price. So that's going to be the next thing that you want to look at. Now, there's different ways that you could buy. You could buy in the money, out the money, or right at the money. So if you're buying at the money at that point, if Apple is at 350 cents, right? you're going to be looking for a strike price of 302.50. So that's going to be right at the money at that point. So your strike price is what you choose based on where the stock is going.
And then you have your expiration date. With options, contracts expire, right? And their expiration date is the day that the contract will be expiring. Whether you do zero DTEs, meaning that those expire that day, or
Yeah.
you're doing weekly or monthly, all contracts have expiration date.
Yeah, and you have to pay attention to the expiration dates, guys, because the more time you have, the safer it is, but the less you make. The
Mhm.
less time you have, the more risky it is, but the more you can make. So you want to pay attention to those as far as how you choose your contracts and the expiration dates. And then you're going to have premiums. The premium is going to be what it costs to pay for those contracts. A lot of times, as beginners, we always recommend that, hey, paper trade first so you could understand certain things, because with zero DTE contracts, while they move fast, hey, you could lose a lot of money very quick with zero DTE contracts. So you have different expirations. You have dailies, you have Monday, Wednesday, Friday, depending on what stock it is. Then you have weekly contracts. Then you have monthly contracts. So all depends. Just pay attention to those.
Then we're going to get into the brokerage and platform terms, some of the most common ones. So we have the bid and the ask. So just so you guys know, between the bid and the ask is something called the spread. That's the difference between that. But the bid is the price that the buyers are willing to pay. The ask is where the sellers are willing to pay. And like I told you, what the spread was, basically the difference between that. So when George and I are trading, you guys, if you want to come trade live with us, you're more than welcome. And that is one of the things that we're always looking at is what is the spread? Does it make sense for us to get into this particular trade? Because if the spread between the bid and the ask is wide, you're automatically going to be down in that. And you have to that into consideration. Is this something that I want to be down that much in? Right? So just be mindful. When you hear us say spread, now you know what we mean.
Yes, and now you got to talk about volume. And volume is going to be the amount of shares the contract is being exchanged over the period of trading, right? So you're talking about how many contracts is being traded at a particular time. So you paying attention to that. The higher the volume, of course, the better it is for you to get into the trade. Why? Because there's more liquidity in that trade, right? So you want to look for liquidity as far as how much interest is in there, right? So when you see liquidity and the liquidity is high, that means that it's easy to get in and out of that trade. You're not going to have any problems. A lot of times people look at liquidity or the volume. If you see volume is low, that means that trade might be hard to get out of. The price might be moving up and you're saying, well, why my contract is not moving? Why it's not selling my contract? Because there's not a lot of volume in it and there's not a lot of liquidity in it at that.
Listen, guys, I know it's a lot of terminologies, right? And this is just some of the basics. We do dive deeper into this inside of our mentorship, or even if you come to our 4-hour training camp, we have all of these
Yeah.
terminologies. I don't want you to feel like you have to memorize everything, right? As you encounter things, then you would understand what this is why I said it's so important to write this down so you can have the notes, so you can refer back to, because sometimes people are like, oh, I don't understand. What does that mean? What does that mean? But you're trading options and you got to be able to understand at least the basics, at least what we spoke about today. Don't feel that you're behind, right? Because you don't understand this. You're going to learn as you encounter them.
It's not going to come to you the first day, okay? But now you're going to get to understand certain things so you could be better, because one of the things is you have to understand the foundation of things.
Yeah.
If you're trading options and you don't even know what the contract means or how you're leveraging contracts, then in a sense you're kind of lost, right? You're only thinking about the money, but you truly want to understand what you're doing as well.
Well, guys, that was it. This was our little beginner's crash, I would say. And this podcast, share this with somebody that's new. Share this with a friend or family that is maybe interested in getting started. Guys, we have a whole community called Married to the Market. It's our Discord. It doesn't cost you anything. You guys are more than welcome to come in there. We have lots of resources there just as well. This is where we give all the updates. Everything goes down in our Discord.
Yeah.
So come say hello or even come trade live with us. Other than that, we will see you guys on the next podcast episode.
All
All
right,
right,
guys.
guys. Bye.